Okay, hello everyone. Hope you're doing well. This is the video lecture for the accounts receivable and revenue cycle topic. Um, it's one of our more important accounts that we're worried about is revenue. Most of the restatements, financial statements are actually due to revenue. Let me say the plurality of restatements are due to revenue recognition issues, and so this can be a pretty important area. And so, as we'll kind of talk about as we go, so just a little reminder where we're at. There's our 6 stages of the audit, and there's a little color change for you. But remember, we're kind of in this middle three, if there is a middle 3 out of 6, where we're going to be applying what we've learned in the past portion of the course to a particular account and transaction cycle, or set of accounts and transaction cycle. So we're going to be doing our obtaining understanding of the client, its environment, internal control, assessing the risk of material misstatement, designing our procedures, and performing them. So that's where we're at. We're just going to apply that now to the AR and revenue cycle process. And as I mentioned before, we're going to take these learning objectives and work on getting them integrated into our way in which we are going to audit through the audit risk model. Okay, so let's look here at the first learning objective, describing the nature of receivables. Again, this is just kind of a reminder of the nature of what's going on here in this account. So obviously, accounts receivable, not obviously, but accounts receivable are significant. We consider those significant accounts most of the time because there's been a history of frauds that have used overstatement of receivables and the corresponding entry to revenue in executing the fraud for financial misrepresentation. And also because, and actually both of these accounts are significant, accounts receivable and revenue. Revenue recognition, depending on the industry, can have complexity in the rules that are used to determine whether revenue can be recognized in a current period or not. I believe you've had exposure to some of the new revenue recognition rules from the FASB, but if you haven't, that is an area that FASB has attempted to provide more structure around, but it's not quite as simple as it used to be, which was, are the revenues earned, and is there a reasonable expectation of payment being made, right? So are they earned and realizable? Those are still bedrock principles, but contracts are much more complex than they used to be, and the revenue recognition standards attempt to address some of that complexity. And there's significant estimates that can go into these, right? Think about bad debt expense. What's the likely, and really the allowance account is what would impact the receivable account, but obviously bad debt expense is the income statement related account, and so those can have a significant amount of variation in where inappropriate, or excuse me, where reasonable people could disagree, right, in terms of where the estimate should land. There's really a range of reasonable estimates, and because of that, there's potential for bias, right? Same thing for revenues in terms of, especially when you think about some of these contracts where it's not just the product, but there's a product and a service component, and possibly other services, post sale services that are provided, maybe some servicing, maybe there's warranties related, and so because of that, there's estimates in terms of how much of that will turn into recognizable revenue, right? So some specific sources of AR, accounts receivable. Obviously, the most common one is the one we're used to, where the client or the company is making a sale to a customer. In exchange of those goods, they get a promise to pay, right? That's what an accounts receivable is. It's a promise to pay. You can also have them from other sources that are definitely less frequent, related to loans to either internal individuals or loans to subsidiaries. and possibly even advances to suppliers, right? So there's other ways in which you can get accounts receivable, but clearly the top one from customers is the one that is the most common. And AR on the balance sheet is usually shown at net realizable value. Oftentimes the allowance, if it's not shown in the columns itself, it is usually shown parenthetically, within parentheses, when presenting accounts receivable. So if you look here, this is an example of what an accounts receivable T account would look like over the course of a month, right? And let's say that credit sales are accumulated on a monthly basis. Let's say you have a sales journal, and every month, just like if you've done the Systems Understanding Aid, once a month you would total up the sales for that month and then post that amount to the AR general ledger and to the revenue general ledger accounts. And so let's say, for example, we have 12 months of these credit sales, and then we have 12 months of cash receipts that are also coming in to pay off the accounts receivable balances. Now, obviously, the flow of sales through accounts receivable is going to be much larger than just the ending balance, right? Because the ending balance is really, when you offset all of these together, what is the net change, right? If in total credit sales is larger than cash receipts, then the balance goes up. But if the reverse is true, or more cash receipts come in than credit sales, then the balance goes down. But clearly, there is a lot that's actually flowing through the account. I'm looking at some data of real-world companies through my research. CompuStat is a source of financial statement data. It suggests that the median sales is about 6 times larger than the typical accounts receivable ending balance. Right? So another way to think about that is around 2 months on average of sales are sitting in ending accounts receivable. Okay, so 2 months as opposed to 12 months worth. So that just gives you a sense of how large the flow is of transactions through the account. And so we do care about the balance, but we also care about the flow. Notes receivable is another balance sheet account here that would also technically be considered in this cycle. It's another significant account. Obviously, this would be loans to individuals or to businesses that we're making sales to usually. And so let's say we're selling equipment and it's equipment with a long life, then oftentimes the company might give us a note in return, right? And when I say us, I mean they might give our client a note in return. And so our client then has this receivable, and oftentimes it could be, it'll have a term on it. Oftentimes there's interest related to it. And so that's another source of a receivable. You could conceivably have it to related companies as well, or to internal individuals, right? So possibly, you might provide a home to your CEO in exchange for a note, and it's compensation because let's say you're a construction company, right? And so one way you might compensate your CEO is to actually build a home for them, and in exchange they are signing a note. But clearly it would probably be for either an amount less than market value, or the interest rate would be less than market value, right? That would turn into a related party transaction. But those are some potential sources. Again, looking at our audit risk model, we want to layer in the other learning objectives here. And really, that first learning objective really could be included in inherent risk, because it gets to the complexity of the transactions, the nature of the transactions. But thinking about the audit risk and the kind of the high level assertions that we need to gain assurance over, again, combine those 6 financial statement level assertions with the actual revenue cycle significant accounts like AR, notes receivable, revenue, and the result is our specific audit objectives, right? And so again, probably And so let's look at that. And so we have these 6 audit objectives that result from the assertions being applied to these accounts. And so existence/occurrence. Remember, existence is technically related to an account balance. So we have receivables that are an ending balance for receivables. We want to make sure that those actually exist, that they're valid receivables. And occurrence is technically related to transactions, so not a balance, but it's related to transactions. And so we want to make sure that those revenue transactions actually occurred, right? They weren't just artificially created and posted to the revenue account. But again, those two concepts are so similar. It's really about the validity, right, of the transactions and the resulting balance in the balance sheet from accounts receivable. But we have our other 6, but existence and occurrence is definitely probably the primary one we're focused on. Cutoff can also be an important one because it gets to potential frauds where companies might attempt to take some of the revenue from next year, right? Keep their books open a little bit longer, book some of the sales that were made in the first week, for example, of the next fiscal year, but bring it into the current fiscal year, right? So cutoff is important. Valuation becomes important as far as the allowance account and the bad debt expense estimate that comes as a result of or as part of that process, making sure that net accounts receivable is appropriate. And so again, we're going to do tests for all of these audit objectives, but we're definitely going to spend more time on existence and cutoff and valuation probably than the other 3. If I keep moving on to inherent risk and the next learning objective, it's obtaining an understanding of the client and the environment. And so understanding the client helps me think about inherent risk, right? So what kind of products and services are sold? Are these products that are sold point of sale? Are they large fixed assets? Is it based on, is there a lot of post-sale services we're providing, right? All these things kind of get into understanding the client and thinking about inherently how difficult or inherently what the risk is that there's going to be material misstatement here, right? Either, again, it could be due to fraud, right? What kind of bias can be introduced, but it also could be due to error, right? So how complex are these transactions might impact the likelihood we're going to get errors as well. And so we're going to be looking at these areas. And again, another important one here is what kind of principles for revenue recognition are common in the industry. Does our client go along with those commonly used revenue recognition principles, or do they have something contrary? And if so, what's the reasoning for that, right? So those are the things that we're going to make sure we understand in order to, in general, understanding that revenue cycle as far as the some of the details around the contracts, right, for sales and delivery and payment and all those things. Those are areas that we're going to look for understanding to see, again, to try and evaluate that inherent risk. And then just to kind of highlight fraud risk is, again, we have a whole separate set of procedures that have to kind of pull out from our regular set of procedures and kind of highlight clearly, yeah, we thought about fraud risk and here's what we did to deal with it. And so some of this is really kind of related to the internal controls and control risk piece, but oftentimes it's part of this understanding process, and the auditor's then response to the risk. And we even had a question on the exam that was talking about responses to risk, and so you can do things like putting more experienced personnel on the audit. You can shift some of the timing to later, kind of after year end, and you can assign specialists, right? Those are all things you can potentially do in response to those risks, including I think one of the things we had on the exam was that the nature of the procedures would be varied from year to year, right? We don't want to be predictable in our audit procedures, because if we're predictable, then that means that managers, if they want to manipulate, could manipulate if they know what it is we're going to do in the audit. The next learning objective is around internal controls. Objective 3 and 5, again, understanding the process, basically the revenue cycle, and then including the controls, and then how do we go about as auditors, that's learning objective 5, in obtaining an understanding of the specific internal control for our client, right? So kind of big picture, there's different documents that go into this process. I think we have a flow chart coming up, so let me just skip on to the flow chart, right, where we have some kind of initiation from a customer. Could be a purchase order. That purchase order could be input into the system. There could be a process to approve the credit based on credit history, based on prior authorization given to the customer. Once it's approved, then the finished goods can be released. Now, in this flow chart, they're showing goods with this circle. That's kind of contrary to what good flow charting guidelines would suggest, but the book used it. And then once the goods have been released for shipping, then you can generate a bill of lading to be shipped with the goods and sent to the customer, right? And so this is a flow chart is an example of an implementation of a process, right? So whatever company the auditor goes to, it has to go and actually figure out what the actual process looks like. This is just an example of how one could look. And so we have the internal control over this process. And so revenue is a high risk account, and so we're going to definitely thinking about the internal control framework as far as the control environment, the risk assessment, specific control activities, which are going to vary based on each transaction cycle, right? And based on how goods kind of flow through the client, then we have these different processes, right? And so, in different steps in the control activities as far as approving credit and how when you actually create an invoice, right, should be after you ship it or after you substantially complete whatever requirements you have, right? That really gets to the revenue recognition piece. And so then we have things like authorization of write-offs of uncollectible accounts. So this is kind of the meat of where the revenue control activities differ from the other areas. Segregation of duties, right? And a lot of this should be reviewed from your other classes, but the general principle of custody should be separate from record keeping, right? Authorization of write-offs should be separate from who is actually who does not have custody of the notes, right? So these are kind of typical custody, authorization, and record keeping should always be separated. Okay? All right.